Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, most of the financial advice you hear is all about saving, right? Save, save, save. But what if I told you the real key to freedom isn't just about pinching pennies? What if it's about strategically spending your way to wealth? It sounds kind of crazy, but that's the core idea in Sam Dogen's book, Buy This, Not That. And we're going to dive right in and break down exactly how this works. Okay, let's start with a feeling I bet a lot of us know all too well. This quote, well, this was Sam Dogen's actual reality when he was working his so-called dream job at Goldman Sachs. Just imagine it, waking up before the sun, stuck under those harsh office lights, just drowning in stress. It's that classic story, right? You work so hard to climb the ladder, and then you get to the top and realize, oh no, it's been leaning against the wrong wall the whole time. And that's the moment when that dream job totally flips and becomes a nightmare. We're not just talking about burnout here. For him, it was literally a life-or-death calculation. He was gaining weight, his body was in chronic pain. He just looked at his life and realized the path he was on was completely, utterly unsustainable. He knew right then and there he had to find an escape plan. So this brings up a really critical question, and it's not just for him, it's for every single one of us. You know that feeling when the daily grind starts to feel less like a career and more like a prison sentence? Well, just pushing through isn't a long-term strategy. You need a real, actual plan to get out. All right, let's get personal for a second. What's your escape plan? Seriously, do you even have one? Dogen's story really forces us to look in the mirror and answer that question. Because here's the truth. Financial freedom isn't something you just wish for. It's something you have to plan for. Okay. So the solution, it doesn't start with some hot stock tip or a new kind of savings account. It starts with a fundamental, deep-down shift in how you think about money and decisions. And that, right there, is the heart of this whole philosophy. And here is the big reveal, the twist. The title of the book, Buy This, Not That, is actually a little bit of a trick. See, it's not really about buying a Honda instead of a Porsche. It's about buying a whole new mindset. The idea is this. Stop buying into the fear of making a wrong move. Instead, start buying into the courage to make the best possible move you can, even if you don't have 100% certainty. That's the real trade. So how do you actually build that kind of courage? Well, Dogen lays out this really powerful framework to help you overcome that analysis paralysis. You know, that feeling of being so overwhelmed by options that you just do nothing. It's what keeps so many of us stuck. He calls it the 70-30 philosophy, and it's all about learning to think in probabilities instead of absolutes. Look, you're never going to have 100% certainty about anything in life. So the idea is you do your homework, you do the research, and if you can get to a point where you're about 70% confident that you're making the right call, you pull the trigger, you act. And you accept that, yeah, there's a 30% chance it might not be perfect, but that's okay. You learn from it, you adapt, and you move on. And this is where the real power of this approach kicks in over the long term. Think about it. If you're consistently making decisions where the potential reward is more than double the risk, you're basically playing a numbers game where the odds are stacked in your favor. Over time, you're almost guaranteed to come out way, way ahead. So what's the big takeaway here? It's that progress beats perfection every single time. Waiting for that perfect moment to invest or to ask for that raise or to finally start that business, come on, you could be waiting forever. Wealth is built by taking calculated action, not by waiting on the sidelines. Okay, so this mindset of taking calculated action, that's the engine driving you forward. But where are we actually going? What's the destination? Dogen makes a really strong case that for far too long, people have been aiming for the wrong target. He says it's time we completely redefine what enough actually means. You've probably heard of the traditional FIRE movement, right? They say you're financially independent once your net worth hits 25 times your annual expenses. But Dogen points out a problem with this. It encourages a scarcity mindset. I mean, the easiest way to hit that goal is just to slash your spending to the absolute bone. His target is totally different. He says aim for 20 times your annual gross income. See the shift? This forces you to focus on abundance, on growing your income, which ultimately grows your potential for wealth so much more. So this number, 20x, that becomes your new North Star. And yeah, it's ambitious, for sure. But by tying your goal to your income and not just your expenses, it forces you to think about growth. It makes you build a much stronger, more resilient financial foundation for the long haul.
So what does this actually look like in the real world? Well, the framework gives you these really clear, tangible benchmarks. So for example, if you're 40 years old and you're making 100 grand a year, your target is $1 million net worth. Suddenly, these aren't just abstract numbers floating around. They become real, concrete milestones on your journey to freedom.
All right, so let's say you do it. You hit your number. Now what? How do you actually live off that money and make sure it lasts? This brings us to another piece of old school financial advice that, frankly, really needs a modern update.
I'm sure we've all heard of the famous 4% rule, right? It's the classic advice: you can safely withdraw 4% of your portfolio every year in retirement and you'll be fine. But with the way the economy is today, is that rule still actually safe? Here's the problem. The 4% rule was created back in the 90s when you could get over 5% on a 10-year bond. We are in a totally different financial world today. With interest rates so much lower, those risk-free returns that the whole rule was built on, they've pretty much vanished. Sticking to that rule now could be a recipe for disaster down the line. So Dogen offers a new way, and it's much more dynamic and honestly more conservative. He calls it the Financial Samurai Safe Withdrawal Rate. You tie your withdrawal rate directly to the current 10-year Treasury bond yield. The formula is simple. Just take that yield and multiply it by 80%. So let's say the yield is 2%, your safe withdrawal rate is only 1.6%. It's a brutally realistic approach, but it's designed to protect your nest egg right when you're most vulnerable, at the very beginning of retirement. Okay, all of these frameworks, all these numbers, they're fantastic tools, but they are completely useless without one final, absolutely crucial ingredient. And it has nothing to do with being born special or getting some lucky break. It's about something much more basic, something we can all control. And Dogen's own story is the perfect example of this. He didn't go to some fancy target school for Goldman Sachs. So how'd he get a shot? Because on one chilly Saturday morning, there was a bus leaving at 6 a.m. for a career fair. 20 other students signed up, and they all bailed. He was the only one who showed up. That one simple act of just getting on the bus led to him getting a chauffeured ride to the event, and after 55 interviews, landing the job. It just proves that sometimes showing up is way more than half the battle. And really, that's what it all boils down to, isn't it? It's about grit, the kind of grit it takes to go through 55 interviews and not give up. It's about consistency, to just keep saving and investing year in and year out. And it's about confidence, the confidence you get from a framework like the 70-30 rule to take those smart, calculated risks. These are the things that actually build wealth. So we're going to end on this one really powerful idea. You can't always control the outcome of things. You just can't. But you can always control your effort. Effort is the one variable that requires zero special talent, no fancy background, just the will to get on the damn bus. And that is a choice that every single one of us gets to make. All right, let's talk about something huge, money. But maybe not in the way you're used to. Today, we're diving into a framework for achieving financial freedom, the kind of freedom that lets you live life completely on your own terms. This isn't just about getting rich, it's about getting free. So let's get into it. So let's start with the most basic question there is. We work so hard, we save, we invest, but for what? If we don't really know the why behind all that effort, we're kind of just spinning our wheels, right? The real goal isn't the money itself. And this, right here, pretty much says it all. The point of money is freedom. It's the freedom to build a life that actually excites you, to make your own calls, and to not be stuck answering to anyone else. Money is just the vehicle. Freedom is the destination. So, okay, freedom sounds great, but what does that actually feel like day to day? Let's break down the 7 incredible rewards that come along with financial independence, or FI as people call it. These are the real tangible reasons why this journey is so worth it. First up, and this one might surprise you, your health. Let's be real, financial stress is a physical burden. The author even mentions that his own chronic back pain and TMJ, that jaw-clenching thing you do when you're stressed, it just completely vanished once he hit financial independence. Getting rid of money worries has a massive positive effect on your body. Second, you get to work without fear. I mean, think about that normal job anxiety, worrying about a tough boss, or the constant threat of layoffs. Financial freedom shatters that cycle. You can be way more creative, you can take bigger swings, and you show up to work because you want to be there, not because you're trapped. Number 3, And wow, this one's a game changer. You can speak your mind. How many times do we see people stay quiet about something that's wrong because they're afraid of losing their job? Financial independence gives you that speak truth to power confidence without having to worry about your paycheck.
The fourth reward is all about what happens inside your own head. And this quote just nails it. A huge part of building wealth is internal. It's about actually believing you deserve it. Taking control of your finances builds this incredible self-confidence. You realize you belong at any table. And that belief, it's like rocket fuel for your life. Fifth, you can stop pretending. No more forced happy hours with coworkers you don't really vibe with. You get to actually curate your social life and spend your precious time only with people who lift you up and who you genuinely enjoy. Number 6 is a really emotional one. Giving your parents peace of mind. Just knowing that they don't have to worry about your future is an unbelievable gift. It's a powerful way to give back for all the years that they sacrificed for you. And finally, for so many people, this is the big one. This is the reward that's absolutely priceless. You only get one shot at raising your kids. Achieving financial independence sooner just means you have more time and more energy to be truly present with them before they're grown and gone. Okay, so we're all on board with why we want it. The benefits are clear. But what are we actually talking about here? What even is financial independence? Let's move on and clear up some myths, because it's probably not what you think it is. So you've probably heard of the FIRE movement, financial independence, retire early. The popular rule of thumb there is on the left. Build a net worth that's 25 times your annual expenses. But the financial samurai approach suggests a more robust target. It says you should aim for a net worth of 20 times your annual income. The logic is pretty smart. This way, your financial goals scale up as your earnings grow, instead of just focusing on pinching pennies. It's also really important to know that financial independence isn't a one-size-fits-all kind of deal. The whole movement has different flavors, you could say. You've got fat FIRE for a high-spending lifestyle, lean FIRE for the minimalists, and even barista FIRE for people who want to cover their bills with a fun, low-stress part-time job. The whole point is finding the version that fits the life you actually want to live. And this right here is the absolute key. You have to focus on the FI part, not necessarily the RE. The goal isn't to just stop working and do nothing. A rich life is usually filled with meaningful work. Financial independence is the thing that gives you the freedom to finally chase the work you're truly passionate about on your own terms. Now we are getting to the absolute heart of it. If financial freedom isn't the final goal but just a tool, then what's it a tool for? Well, it's a tool for happiness. And here's the kicker. A massive part of that happiness has absolutely nothing to do with your bank account. So here it is, the core formula. Happiness equals reality minus expectations. Just think about that for a second. It's so simple, but so powerful. If you expect an okay dinner and get an amazing one, your reality crushed your expectations and you're happy. It's all about managing those expectations and appreciating the good things you already have. So how much does money really matter in this whole equation? Well, according to the author, once you have enough to live comfortably, money determines at most 40% of your happiness. This chart makes it so clear. That 40% from money, that gets maxed out pretty quickly once your basic needs are met. The other 60%, the lion's share of your happiness, that comes from your relationships, your purpose, your community, all the stuff money just can't buy. So to figure out that crucial 60%, you have to get specific. You've got to define what freedom actually means to you. You need to ask yourself these big questions. What do you really want to do with your time? Who do you want to share that time with? And where in the world do you want that life to happen? Okay, so once you have that clear vision of your ideal life, it's time to get practical. You've got to put a price tag on that freedom. Let's take a look at how to actually calculate your number. Now, don't get bogged down in the specific numbers here. This is just one example for a family living in a pricey city. The key takeaway is the process. You have to honestly list out all the costs that go into your ideal life, from the mortgage and childcare to vacations and hobbies. This is how you find your target income number. So here it is, the whole game plan laid out. The Financial Samurai Way is basically a 4-step process. First, you define your North Star, your what, who, and where. Second, you price it all out with a realistic budget. Third, you work toward that net worth goal of 20 times your income. And finally, you use that growing financial strength to start making real positive changes in your life.
And always remember, this isn't some destination where you finally arrive and just stop. It's a continuous journey. You're always going to be making progress, adjusting your sails, and improving. It's all about growth, not about reaching some imaginary finish line. So, we'll leave you with this. After everything we've talked about, the most important question is the one only you can answer. So take a moment, really think about it. What does your freedom look like?
Hey, welcome. Today, we are going to build your blueprint for financial freedom. We're going to break down a super practical framework for building wealth and finally achieving that independence you're looking for. And it's all based on the fantastic work of Sam Dogen, the founder of Financial Samurai.
Look, financial freedom isn't some kind of magic, and it's definitely not about winning the lottery. At its core, it's a math problem, and like the source material says, once you do the math, the plan will come. It's all about you taking control of the numbers so you can build the life you really want. This is the big one, isn't it? This is the question that drives every single financial decision we make. Before we can even start building a plan, we have to know where we're going. We have to define the destination. How much money do you actually need to call yourself financially free? Well, according to this framework, there are two clear finish lines. You've hit financial independence when one of two things happens. First, when your net worth, that's everything you own minus everything you owe, simple as that, hits 20 times your average yearly gross income. Or the second path is when your investments are generating enough passive income all on their own to completely cover your ideal lifestyle. Those are our two North Stars. So, to hit those really ambitious goals, we're going to need a map. And that brings us to our first section, setting a super clear, measurable destination for your financial journey. This is your guide, your financial North Star. And here is that map. Now, think of this table like a personal trainer for your finances. It's a guide, not some rigid, unforgiving rule. Just find your age, look at your income, and see the target. So, let's say you're 40 and you're making $100,000 a year. Boom, the target is a $1 million net worth. It's an incredibly powerful tool to just keep yourself motivated and know you're on the right track. You know, the thinking behind these numbers is so important. Why focus on a multiple of your income instead of your expenses? Well, this quote just nails it. It shifts you away from that scarcity mindset where you're always just thinking about cutting back and scrimping. Instead, it puts you in an abundance mindset where the focus is on growth and actually building your best life. Okay, so we've set our destination. Now let's jump ahead to the end of the journey, retirement. And here, it's time to challenge a piece of conventional wisdom that, let's be honest, many of us have just taken for granted for years. We've all heard it a million times, right? The 4% rule. The idea that you can safely pull out 4% of your portfolio every single year in retirement and never run out of money. The problem? That rule was created back in the 90s, when the entire economic world was completely different, especially when it came to interest rates. In this chart, wow, this chart shows you exactly why those old assumptions are so risky. On the left, you see the super high historical returns for stocks and bonds that the 4% rule was built on. But then you look to the right, and you see Vanguard's forecast for the next decade, and it's much, much lower. The game has totally changed. So if the old rule is broken, what's a smarter way forward? Well, Dogen proposes this dynamic formula. It's called the Financial Samurai Safe Withdrawal Rate. It's actually really simple. You just take the current yield of the 10-year Treasury bond and multiply it by 80%. That's it. This gives you a rate that actually adapts to what's happening in the economy right now. Now, at first glance, you might be thinking, whoa, that sounds really conservative. But here's the kicker. The logic behind it is identical to the original 4% rule. See, back then, the risk-free bond yield was around 5%, and 4% is just 80% of that. This new formula applies the exact same thinking. It's just updated for today's world. It's all about protecting yourself when you are most vulnerable. Okay, so we have a target and we have a withdrawal strategy for the end. But what about the journey itself? Because it is not going to be a straight line. That brings us to our third section, understanding and measuring your real risk tolerance. This is such a powerful way to reframe risk. It's not just about losing money. It's about losing time. How many months or years of your life would you have to spend working just to earn back what you've lost in a market crash? That is the real measure of risk. And we can actually quantify this for ourselves. It's a super simple 3-step formula. First, take the amount you have in a stock market and multiply it by 35%. That's the average decline in a bear market. Then you take that potential loss and divide it by your monthly gross income. The result is a number. And that number, that's your risk tolerance multiple. It is the number of months you would have to go to work just to get back to where you started. So take a second and actually ask yourself, what's your number? This calculation makes risk real, and it makes it deeply personal.
So once you have your number, this guide gives it some context. If your multiple is 3, you're ultra-conservative. You're basically willing to work just 3 months to make up a loss. If it's 24 or 2 years, you have a pretty high tolerance for risk. This helps you make sure your investments are truly lined up with your willingness to trade your time.
All right, let's move to our final section, and honestly, this might be the most important part of the whole blueprint. It's about finding the motivation to actually stick with the plan by connecting all of these numbers to what really matters, your life.
Check this out. It's a concept Dogen calls income tethering, and this croissant calculation makes it so clear. That small joy, maybe an $8 croissant on the weekend, costs about $416 a year. Now, to pay for that croissant forever with just a modest 3% return, you need to invest about 14 grand. Suddenly, saving has a delicious, tangible purpose. And this idea works on a much bigger scale, too. The trick is to always finish the sentence. You don't just say, I invested in Apple. You finish the sentence. My investment in Apple paid for the down payment on my house. See? You're connecting the financial tool to a life-changing goal. And, this isn't just about stocks or financial investments. It's about your investment of time and effort. 10 years of working on a blog isn't just a project, it's the asset that paid for the priceless freedom to be with family. The big takeaway here is that money just for the sake of having money is empty. It's a tool. And like any tool, it's defined by what you use it for. Saving and investing without a purpose is like collecting a garage full of hammers you never, ever intend to swing. Which brings us to our final thought. All these numbers, all these targets and formulas, they're just the blueprint. The real question, the one that's going to keep you going on this long journey, is this: what are you building with it?
So much financial advice is all about setting goals. But let's be honest, a goal without a real plan is just a dream. So today, we're getting past the dreaming part and jumping straight into action. We're going to break down the Financial Samurai's super powerful strategy for not just getting cash, but, and this is the important part, putting that cash to work for you.
For our parents, our grandparents, this is what building wealth looks like, right? A slow, steady grind over 40, maybe 50 years. You put your money away, you wait, and hopefully, if you were lucky, you had enough to retire around 65. But what if there's a much faster, much smarter way to do this?
Now, I'm serious. Really think about that for a second. We're not talking about retiring just a few years early. We're talking about the possibility of doing it in your 40s, maybe even your 30s. Now, that probably sounds crazy, but this strategy says it's totally possible, but you have to completely change the way you think about your money. So, let's see how it works. Okay, so here's the core idea. And it's actually pretty simple, but it's also profound. You need to build a massive money army. And this isn't just a pile of cash sitting in a bank account. No. This is an active force of investments all working for you 24/7, generating income so that one day you don't have to work at all.
This slide right here, this is absolutely critical. On the one hand, you've got your 401k or IRA. Think of that as your retirement fortress. It's locked down, you can't touch it without penalties until you're almost 60. But on the other side, you have your taxable portfolio. That's your active duty army. That's the money that's generating income you can actually use right now to buy back your time and your freedom. This portfolio, this is the engine for early retirement. So, how do you recruit soldiers for this money army? Well, they don't just appear out of thin air. It all starts with building your war chest. And you do that with a super disciplined, super aggressive savings plan. All right, here's the optimal game plan. Step 1, you max out those pre-tax retirement accounts, like your 401k. Then, and this is key, you save a minimum of 20% of your after-tax income and put it straight into that taxable money army portfolio. Now, what if you can't max out the 401k just yet? Okay, the second best option is non-negotiable. You have to, at the very least, contribute enough to get your full company match. That's a 100% return on your money instantly. You cannot leave that free money on the table.
This chart is where you can really see the magic happen. It shows you just how powerful that savings rate is. So look, at a 20% savings rate, after 10 years, you've saved up about 2.5 years of living expenses. That's not bad. But watch what happens when you jump up to a 50% savings rate. All of a sudden, you've got 10 years of expenses in the bank.
The acceleration is just incredible. And here's the part that just blows my mind. If you can really get aggressive and hit a 75% savings rate for just 10 years, you will have banked 30 years' worth of living expenses. 30! This completely shatters that old idea that financial independence has to be a 40-year journey.
Okay, so you've got the cash. You're saving like a champion. Now comes the big question. Where do you deploy these troops? Because not all investments are created equal. Let's get to the rankings and see how these passive income streams really stack up from worst to best based on the author's own experience over 2 decades.
Before we dive in, here's how they're being judged. It's a pretty straightforward system. Each investment gets a score from 1 to 10 across these 6 categories you see here. A score of 10 is awesome. Low risk, high return, super easy. A 1 is, well, not so good. It's a great way to see how they compare side by side.
All right, coming in at the bottom of the list, number 8 is peer-to-peer lending. Now, the idea sounds cool, cutting out the banks, but the reality is that the default risk is just way too high. I mean, just look at the scores for risk and return, a 4 and a 2. Yikes. That pretty much tells you everything you need to know. It's just not a reliable soldier for your army.
At number 7, we've got private equity. And hey, the potential return is huge, an 8 out of 10. This is the dream of getting in early on the next Google. But, and it's a big but, look at feasibility and liquidity. They're both a dismal 3. These deals are really hard to get into, and your money is locked up for years and years. So yeah, high potential, but super low accessibility for most of us.
Next up at number 6 and 5, we have the old guard, CDs and bonds. Their main selling point is safety. I mean, a CD gets a perfect 10 for risk. It's basically a financial fortress. But their fatal flaw? The return. A 1 and a 2. They're just not going to generate any meaningful income. So they're safe for sure, but they won't help you win the war for financial freedom.
Now we're breaking into the top 4, and this one is really interesting. Creating your own products. Think ebooks, online courses, maybe selling your photography or art. Just look at those really solid scores across the board, especially those 8s for risk, return, and feasibility. There's something incredibly rewarding about making money from your own creativity, and the sky's the limit.
In third place is an absolute classic, physical real estate. You can touch it, it provides shelter, and it generates income. And can we just talk about that perfect 10 for taxes? The benefits there are massive. The only real drawback is that activity score is 6. Yeah, dealing with tenants and toilets isn't for everybody. But the power to build wealth here is just undeniable.
And the author really drives this point home with this quote. For the average person, real estate just makes sense. It's easy to understand, it's a real, tangible thing, and it produces income. That makes it a top-tier choice for building serious wealth.
Our runner-up at number 2 is online real estate. This is basically how you get all the benefits of real estate without any of the headaches. We're talking about things like REITs or crowdfunding platforms. You can invest in property and be completely passive. That's why it gets a perfect 10 for both feasibility and activity. It's real estate for the modern hands-off investor.
And the number 1 ranked passive income stream is dividend investing. Now, I know what you might be thinking. You see that return score of 5 and you're like, wait, why is that number 1? Well, look at the other scores. Feasibility, 10. Activity, 10. Liquidity, 9. It is the easiest to start, it's 100% passive, and you can get your money out pretty much instantly. That unbeatable combo of ease and flexibility makes it the top choice for deploying your money army.
So here's the thing. Choosing your investments, that's a huge piece of the puzzle. But it's only half the battle. Winning the real war for financial freedom takes discipline and a relentless commitment to your plan, year after year. This is your battle plan. Once a month, you sit down and you review everything. You ask yourself, am I on track? You write down your goals to make them real. You automate your savings so it just happens without you even thinking about it. And the most important part, you stay consistent. You just chip away at it every single day, every single paycheck. That's how you build your army. Okay, let's pull all of this together. What's the core philosophy here? What's the one big idea you absolutely have to take away from all this?
This is it. The financial samurai way is not some get-rich-quick scheme. It is a disciplined strategy. It's about saving aggressively, building up that taxable portfolio, that money army, and then intelligently deploying that cash into investments that will fight for your financial freedom every single day.
And why go through all this trouble? Because of this. This quote just says it all. The true sacrifice isn't saving money. It's living a life you don't control because you don't have the funds to make your own choices. This entire strategy is about taking back that control.
So the plan is all laid out. The troops are ready to be recruited. The only thing left to do is to start. The question isn't whether it's possible. The question is, what action are you going to take first? What's your first command?
All right, let's talk about debt. But we're not just going to talk about how to manage it. No, we're going to give you a simple, powerful formula to finally answer that question, should I pay down debt or should I invest? And then we'll lay out a clear roadmap for your long-term wealth. It's time to start mastering your money.
So let's kick things off with this really powerful idea from author Sam Dogen. The problem, at its core, is just so simple, isn't it? It's incredibly easy to get the lifestyle we want right now, way before we've actually put in the work to earn it. And hey, this isn't about judging anyone. It's just the reality of how modern credit works. Really getting that is the absolute first step to taking back control.
So here's our game plan. First, we're going to dive into the why, the psychology behind debt. Then we'll learn how to split debt into two camps, good and bad. From there, we'll build a hit list to attack your debt. I'll give you a simple formula to solve that whole debt versus invest debate, and then we'll zoom out and build your long-term wealth plan.
Okay, first up, the psychology of debt. What's really going on in our heads? Why do we fall into this trap in the first place?
You know, at the end of the day, debt is just a shortcut. It's a really tempting one, too. It's like getting to skip the entire line for the roller coaster and get right to the fun part. But that shortcut, that instant gratification, well, it isn't free. It comes with a really, really heavy long-term cost.
This right here perfectly captures the whole problem. You see, when you have debt, you become the passive income stream, but for somebody else. Every single interest payment you make is just you working hard to build the bank's wealth, not your own. You're literally funding their future.
Okay, on to section 2, good versus bad debt. Here's the thing, not all debt is your enemy. The real key here is to start thinking like the person who's lending the money, not the one who's borrowing it. And here it is, the critical difference. Bad debt, that's what you use to buy stuff that loses value. You know, cars, fancy clothes, the latest phone. But good debt is all about leverage. It's about using borrowed money to buy assets that can actually grow in value, like a business or maybe some real estate. One is just a drain on your wealth. The other, well, the other can be a powerful tool to build it.
Section 3, your debt hit list. All right, so you know the enemy now. It's time to put together a plan of attack. Here's exactly how you should prioritize.
And there's a really good reason they're ranked this way. You absolutely have to start with the most toxic, highest interest debt first, and that is almost always credit cards. Then you move on to car loans, because they're tied to something that's losing value every single day. Student loans are next, and then finally you have mortgages, which can often be considered good debt since they're tied to an asset that's hopefully appreciating. Okay, now for the part I know you've been waiting for. This next section is a game changer. It's a simple but incredibly powerful formula that helps solve one of the biggest, most common money puzzles out there. I mean, this is the dilemma, right? It's the one so many of us face. You get to the end of the month, you've got a little extra cash, so what do you do with it? Do you throw it at your loans, or do you put it into the market and hope it grows? It can feel like a total guess, but there is a logical, clear way to decide. And here it is, the FS DARE formula. It's just a really simple way to take all the emotion out of this big decision. All you do is take your debt's interest rate, multiply it by 10, and boom, that number is the percentage of your extra cash that you should put towards paying down that debt. Simple as that. The key number here, the magic number, is 10%. If your debt has an interest rate of 10% or higher, the formula says you should put 100% of your extra cash toward destroying that debt. Anything less than that, and you start splitting your money between debt and investing. So why 10%? Well, it's because paying down a debt with a 10% interest rate is like earning a guaranteed 10% return on your money. Think about that. The stock market's historical average is also around 10%, but that's just an average. It is definitely not guaranteed. This formula prioritizes the sure thing every time. And here's what that looks like in the real world. Got a 3% mortgage? Okay. The formula says 30% of your extra cash goes to that mortgage, and the other 70% goes to investing. A 5% car loan? That's a 50-50 split. But that nasty 15% credit card balance? 100%, every spare dime goes to crushing that debt. It's just a logical, balanced way to handle any situation you're in. Look, mastering your debt is the first and honestly the most crucial step. but it's just one piece of a much bigger picture. So now let's talk about the long-term plan for not just growing your wealth, but also, and this is just as important, protecting it. This is all about your asset to liability ratio. The best way to think about it is like a seesaw. When you're young, you can have more debt or liabilities compared to your assets. That leverage can help you grow faster. But as you get older, you want that seesaw to tip heavily, heavily in favor of assets to protect everything you've worked so hard to build. It's about using leverage when you have time to recover and then shifting to protecting your capital as you get closer to retirement. And this is basically your roadmap. It shows you exactly how to gradually, intentionally de-risk your finances as you move through life. The idea is, by the time you're in your 60s, you want to have at least 10 times more in assets than you do in liabilities. You're essentially building a strong financial fortress for your retirement years. Because ultimately, this is what it's all about. Mastering your debt isn't just a numbers game on a spreadsheet. It is about taking back control. It's about gaining the freedom and the confidence to stop working for your debts and to start building the life that you actually want. So the question I want to leave you with is this: what would you do if you were completely, totally debt-free? Welcome to The Explainer. Today, we're going to break down the strategy for hitting financial independence, straight from Sam Dogen's book, Buy This, Not That. We are literally mapping out a clear path to building your wealth, step by step. You know, a lot of us are doing what we think is the right thing. We're diligently saving in our retirement accounts, right? Like a 401k or an IRA. We max them out, we watch them grow, and we think, okay, I'm on track. But what if that's not the whole story? What if there's a huge piece of the puzzle we're missing for real early financial freedom? Well, here it is. The real key lies in what you're building outside of those tax-sheltered accounts. I mean, think about it. You can't touch that retirement money until you're almost 60 without getting hit with a penalty. So your ability to retire early or even just have more options sooner depends completely on the wealth you build in your regular taxable accounts. So here's the big core principle. The ultimate goal is to grow your taxable investments, we're talking brokerage accounts, real estate, your own business, to be 3 times the value of your tax-advantaged retirement funds. So for example, if you've got $200,000 in your 401k, you're shooting for $600,000 in your other investments. That is the engine that's going to power your early financial freedom. Okay, so what are the actual building blocks of this strategy? Let's break down the core asset classes you'll be working with. You can kind of think of it like gathering all your ingredients before you start cooking up your financial future. So your total net worth is going to be built from a mix of these 5 key ingredients. You've got stocks and bonds, that's for your growth, real estate, which is a classic wealth builder, risk-free assets like cash for that safety net. Then you have alternative investments for diversification. And finally, my favorite, the X factor. This is your own business or side hustle, and you'll see just how crucial this piece becomes. Now, here's a really critical rule of thumb when it comes to real estate. It is so easy to become house rich, but cash poor. To make sure that doesn't happen, Dogen says your home should just be one part of your wealth, not the whole thing. Keeping it under 30% of your net worth, make sure you have plenty of capital working for you somewhere else. All right, now we get to the core of the strategy. And here's the thing. There isn't just one right way to do this. There are 3 pretty distinct roadmaps you can follow, and it all depends on your goals, your personality, and, yeah, your stomach for risk. Okay, let's dive into these. You've got to ask yourself, which one of these sounds like you? Are you the conventional traveler, taking that proven, steady route? Are you maybe looking for a new life, ready to pivot in your 40s? Or are you a financial samurai, willing to bet big on yourself for that ultimate prize of early freedom? So, the conventional path. It's straightforward, it's time-tested. This is really for people who are totally fine working until the traditional retirement age. And if you look here, you'll notice that by age 30, the model recommends owning a home, which makes up about 55% of your net worth, and having about 5% in risk-free assets just for that extra stability. Now, the new life path, this is for anyone who hits their stride and realizes, you know what, I want to change, maybe after 20 years in the workforce. And what's super interesting is when this path pivots. See how at age 40, a point where you've likely built a solid financial base and a ton of experience, 2 new categories just pop up: alternative investments and your X factor. This is your side hustle, your passion project. The model is basically saying this is the perfect time to start taking some calculated risks on new ventures.
And then there's the financial samurai path. And this isn't just a strategy, it's more like a whole philosophy. It's for that entrepreneur deep down inside, the one who's aiming to build a business that becomes the absolute cornerstone of their wealth. This is the path that allows for freedom way earlier than anything traditional. And this table just illustrates that philosophy perfectly. Just look at the X factor column. It starts out small, just 5% at age 30, but then it grows and grows until it becomes 50%, half of your total net worth by age 60. This is a very deliberate, aggressive plan to make your own thing the primary driver of your wealth. Okay, so now that we've got the overall asset allocation, let's zoom in on a really critical component, the engine of your portfolio. How do you actually balance the stocks and bonds within each of these paths? Because this mix is just as important as the bigger picture.
The conventional model uses that classic, time-honored formula you've probably heard of. You just subtract your age from 100 to figure out your stock percentage. So if you're 40, you're at 60% stocks. It's a super simple way to automatically get more conservative as you get older. But the New Life model, it adapts this rule for the fact that we're all living longer and we need more growth. So it uses 120 minus your age. At 40, you're now at 80% stocks. This keeps you invested more aggressively for a longer period of time because, let's be real, retirement might last 30, 40, or even 50 years. Okay, before we check out the last model, we need to understand this key concept that Dogen introduces called bonds plus. In a world with super low interest rates, traditional bonds might not be all that exciting. So this approach looks at real estate as a kind of supercharged bond alternative. It gives you stability, but with way more potential for growth. And this is where that bonds plus idea really comes into play for the financial samurai. This model has a shockingly heavy stock allocation. I mean, look at this. It's still 80% stocks at age 60. And you might be wondering, how is that even possible? Well, it's because instead of using traditional bonds for safety, this model completely replaces them with real estate, using property as the portfolio's stabilizer. That's the bonds plus concept, right there in action. A roadmap is pretty useless without the right mindset for the journey. After all, your psychology, how you think about wealth, risk, and your own abilities, that's really the final and maybe the most important piece of this whole puzzle. This old Wall Street saying is just such a powerful reminder to stay disciplined and avoid greed. You can be optimistic or pessimistic and still make money. But if you get greedy, if you start chasing crazy returns without a plan, you risk losing everything. The takeaway? Don't be a pig. So let's just recap the core principles here. First, aim for that 3x taxable to retirement account ratio. Next, pick one of the three models, conventional, New Life, or financial samurai, and just stick with it. That's how you keep emotion out of your decisions. Use real estate as a powerful bonds plus tool, stay humble, and finally, accept that downturns are going to happen. It's just a normal part of the journey. Look, at the end of the day, this isn't just about spreadsheets and numbers. It's about designing the life you actually want to live. These frameworks are just tools to help you get there. So the only question left is which one of these paths best fits your vision for the future. The choice is all yours.
All right, let's talk about building wealth. It can feel, well, super complicated, right? But what if I told you that you could seriously optimize your investments with just a handful of key decisions? That's exactly what we're going to break down today. And the goal? It's pretty simple, actually.
And really, it all comes down to this one big question. This is the ultimate challenge for every single one of us who invests. And I promise, by the end of this, you're going to have a super clear framework to answer it. You'll be thinking less like a saver and way more like a strategist.
Okay, before we dive into all the nitty-gritty details, let's just take a step back and remember the big picture. I mean, look at this. Real wealth, it's a lot like this ancient tree. It starts small, grows slowly, and then over time, it becomes this incredibly powerful force. Every single smart choice you make today, it's going to compound in ways that honestly will probably blow your mind decades down the road.
And this right here is the core mindset shift we're talking about. This is huge. You're not just, stuffing money into a piggy bank anymore. Nope. From now on, you are the chief investment officer, the CIO of your own finances. And every single decision we talk about from here on out, you got to make it from that powerful point of view.
So you're the CIO now. What's your first move? What's the first big decision you make? Well, you might be surprised. It's not what to buy, it's where to put your money. Yeah, choosing the right type of account is literally the foundation of your entire investment strategy. It's that important.
Okay, so here's the fundamental trade-off you need to understand. On one side, you've got your regular taxable accounts. These are all about flexibility. You can put in as much as you want, pull it out whenever you need it, super simple. But on the other side, you've got tax-advantaged accounts. Think your 401k or a Roth IRA. Now, these give you some massive tax breaks, but there are more rules. You've got contribution limits, penalties if you withdraw early. So the pro move here isn't about picking one or the other. It's about learning how to use both of them together strategically.
And that leads us perfectly into a legit pro-level strategy. Once you've got both types of accounts set up, the real game begins. The next step is putting the right investments into the right buckets. Why? Because this is how you attack your single biggest investment cost, taxes. Seriously, this can make a huge difference.
All right, here is your cheat sheet. This is so important. The key thing to get is that not all investments are taxed the same way. So let's break it down. Think about things that create a lot of taxable events, right? Like actively managed funds that are constantly buying and selling, or REITs, those are real estate investment trusts, that kick out dividends taxed as regular income. All that stuff, you want to tuck it away inside your tax-advantaged accounts to shield it from the taxman. But then you have investments that are already pretty tax-friendly, like low-cost ETFs and index funds you plan to hold forever. Those are a perfect fit for your taxable account. I'm telling you, just getting this one thing right is one of the most powerful ways to boost your returns without taking on a single extra bit of risk.
And this quote, wow, it's the perfect example of what happens when you get this stuff wrong. The author, Sam Dogen, he was day trading in a taxable account. Not only was he racking up a huge tax bill, but as you can see, he got some unwanted attention at work. It's just a really powerful warning. Keep that high-frequency trading in the right kind of account, or you'll pay for it one way or another.
Okay, so we've sorted out the where. We know which buckets to use. Now for the fun part. Let's build your growth engine. We're going to figure out what to actually invest in. This is all about picking the right assets that are going to power your journey to financial freedom. And the strategy we're looking at is called the Index Plus strategy. I love this because it's so simple, but it's also incredibly powerful. Here's how it works. The vast majority of your money, your core, goes into those super reliable, low-cost index funds. Easy. Then, you take a smaller slice of your portfolio to pick individual stocks. This gives you a shot, a real chance to actually outperform the market.
And here's a great visual of what that looks like. See that big 80% chunk? That's your foundation. That's your bedrock. It makes sure you capture the market's growth slow and steady over the long haul. And that 20%, well, that's your plus. That's where you get to invest in companies you really believe in without betting the farm. You know, the real beauty of this isn't just financial, it's psychological. Knowing your core is safe and growing gives you the peace of mind to take a few calculated risks with that smaller portion. It's the best of both worlds.
All right, so let's zoom in on that stock-picking slice of your portfolio. The big question is, should you go for growth stocks, you know, the ones that reinvest all their profits to get bigger, faster, or dividend stocks, the ones that actually pay you cold, hard cash? Well, the answer might surprise you. It really all depends on how old you are.
This timeline just lays it all out perfectly. Check it out. When you're in your 20s and 30s, you've got time, lots of it. So you can go all in on growth stocks to build that portfolio as fast as possible. But look what happens. As you get older, you see this gradual shift. Your priority moves away from pure growth and towards generating income. You slowly start adding more and more dividend stocks to create a reliable stream of cash for when you eventually retire. Makes sense, right?
Okay, so we have built the core of our strategy. We know what we're doing. But listen, being a great CIO isn't just about making the right moves, it's just as much about avoiding the wrong ones. So now, I have to give you a major warning about a very tempting, very flashy, and, for most people, an absolutely disastrous trap: angel investing.
Yep, it doesn't get much clearer than that. The advice here is just a hard, simple no. Look, I get it. It sounds so exciting, right? Getting in on the ground floor of the next huge startup? But the reality is, for the average person, it's a game you're almost guaranteed to lose. Let's dig into why that is.
This number right here tells the entire story. The author put his money into a gin company that was actually acquired. I mean, by all accounts, this was a successful angel investment, a win. But after having his money locked up for a full decade, his annualized return was just 5.1%. You could have made more in a boring old index fund with way less risk, and you could have accessed your money anytime you wanted. It's just not a great deal.
So here's the bottom line on angel investing. You're playing a game where the odds are completely stacked against you. The professional venture capitalists, they see all the best deals. Your little stake is probably going to get diluted into almost nothing. Your money is locked up for years with zero liquidity, and the median returns, they're dismal. We're talking close to 0%. It's just not worth the massive risk.
Woo! Okay, we have covered a ton of ground, so let's bring it all home. Let's put it all together into a clear, simple action plan. This is your framework, your playbook for becoming the CIO of your finances, and you can start today.
All right, here it is, the financial samurai way. Super simple. Step 1, practice tax-efficient investing. Put your assets in the right buckets. Step 2, max out that 401k and Roth IRA first, every single year. Step 3, use the Index Plus strategy, keeping at least 80% of your portfolio in passive funds. Step 4, focus on growth stocks when you're young and shift to dividend stocks as you get older. And finally, Step 5, just say no to individual angel investing. That's it. That is your roadmap to success.
So that leaves us with just one final question for you. You have the framework now. You have the playbook. So take a look at your own finances, your own investments. What's the very first move you're going to make as the brand new CIO of your financial future?
Welcome to The Explainer. Today, we are diving into one of the biggest and, frankly, scariest financial decisions you will ever make: buying a home. We're going to lay out a proven system to help you do it right, so you can turn what feels like a huge risk into a serious wealth-building machine. So buying a home, it's this huge milestone, right? But with so much of your money on the line, it's easy to wonder, am I making a smart move or am I walking right into a financial trap? That fear is totally normal, but the way through it isn't fear, it's discipline. Because here's the thing, the biggest danger out there isn't a bad market, it's our own emotions. Just think back to the 2008 crisis. People got caught up in feelings, thinking they deserved a certain house, and it led to absolute disaster. Big money and big emotions, they just don't mix. Okay, so let's get into it. To make a smart, emotion-free decision, you've got to understand where you stand in the market right now. Are you short, neutral, or long? Let's figure it out. All right, so if you're renting, you're what's known as short the market. It's like you're betting that housing prices will go down. But let's be real, that's a risky bet long term. You're basically at the mercy of your landlord. When rents go up, you're stuck, and none of that money is building your own wealth. Now, when you own the home you live in, you become neutral. You're out of the rent race, your home's value just kind of rides the wave of the market. And every single mortgage payment you make is basically paying yourself. It's building your equity. But the real power position, where you can actually accelerate your wealth, that's being long real estate. This means you own more than just your own home. You're an investor, actively profiting from rising rents and property values. This is the goal. And this isn't just some abstract idea. This distinction is critical. Why? Get this. According to a 2019 survey, the average net worth of a homeowner is nearly 40 times greater than a renter's. Nope, not a typo. 40x. That's the power of forced savings, appreciation, and using leverage. So the big question is, how do you make that jump from renter to owner without taking on a crazy amount of risk? Well, it comes down to a really simple but powerful set of rules, a playbook to keep your finances safe and your decisions disciplined. First up, your total monthly housing payment, and I mean everything, principal, interest, taxes, and insurance, the whole shebang, it should never ever be more than 30% of your gross monthly income. This is what keeps you from being house poor. Second, and this is before you even start browsing Zillow, you need to have saved up 30% of the home's value in cash or stuff you can sell quickly. This is your financial armor. So let's break down that 30%. 20% is for your down payment. That's the magic number to avoid paying extra for private mortgage insurance. But that other 10%, that's the secret sauce. It's your cash buffer, your emergency fund for when life happens. And the final piece of the puzzle, the total price of the home should be no more than 3 times your annual gross income. Now, you might be able to stretch that to 5 times if interest rates are super low, but only if you've absolutely nailed the other 2 rules. Okay, you've got the rules for buying responsibly. Now it's time to shift your mindset. Let's go from thinking like just a homeowner to thinking like a savvy investor. And this next strategy, called BURL, is going to completely change how you look at real estate. BURL. It stands for Buy Utility, Rent, Luxury. It's a simple idea. You should own the practical workhorse properties that actually make you money, that's the utility, and just rent the fancy, over-the-top, aspirational ones when you want to experience them. Here's where it gets interesting. The real cost of living in your home isn't just your mortgage payment. You also have to consider the opportunity cost. That's the rent you're not collecting by living there yourself. And this just illustrates the rent luxury idea perfectly. For this high-end home in San Francisco, owning it would cost you over $128,000 a year when you add it all up. But renting it, only $90,000. It's almost a $40,000 difference. Renting is the clear financial win here.
But now, let's look at the buy utility side. For a practical property in the Midwest, the numbers totally flip. It costs just $13,000 a year to own, but it would cost $24,000 to rent. In this case, owning is way cheaper. This is the kind of property that builds your wealth.
All right, let's move to the final piece of the master plan. You've bought the right kind of property, and now you need the right kind of loan. Picking the right mortgage can literally accelerate your path to being completely debt-free. This line from Death of a Salesman really hits home. It's a powerful reminder of what the real goal is. It's not just to have a mortgage. It's to own your house outright, to have the freedom that comes when you're done sending those checks to the bank.
And this is how you get to that finish line faster. A 15-year mortgage? Yeah, the monthly payments are higher, but look at the difference in total interest on $1 million loan. You'd save over $300,000. That is life-changing money you're not just handing over to the bank.
You know, it's not just about saving on interest. A shorter mortgage is like a supercharged savings plan. A way bigger chunk of each payment goes straight to paying down the loan, which means you build your net worth so much faster. And hey, if you already have a mortgage, you're not stuck. You can always look into refinancing. But here's the rule of thumb. Only do it if the money you save each month will cover the closing costs in 18 months or less. So, at the end of the day, it all comes down to this. Every decision you make, the house you pick, the loan you choose, it should all point toward one single powerful goal: owning your home free and clear by the time you're ready to retire. So can your home, your biggest liability, actually be your best investment? With a disciplined framework like this, the answer is 1,000% yes. It's not about the house, it's about the choices you make around it. And if you follow these rules, you can turn your biggest expense into your greatest asset. The only question is, are you ready to start thinking like an investor? You know, choosing where you live is easily one of the biggest financial decisions you'll ever make. Seriously, it's so much more than just a roof over your head. It's about setting the stage for your future wealth. So let's just get right to it. Is your address a launching pad for your net worth, or is it an anchor just holding you back? It's a tough question, I know, but we've got to ask it. And here's why. It turns out some of that classic, well-meaning real estate advice you always hear, yeah, it might actually be costing you a fortune. So in this explainer, we're going to flip some of that conventional wisdom on its head. All right, so here's what we're going to tackle. First up, should you actually move to an expensive city? Then we'll debunk the whole forever home fallacy. We'll also get into the prime versus up-and-coming neighborhood debate, figure out if you should buy a house, condo, or multi-unit, and wrap it all up with your very own wealth-building blueprint. Okay, let's dive right into our first big myth, the idea that you should always flee high-cost cities. I know, it sounds completely backward, right? But what if the smartest move is to run towards the expensive places? And this brings us to a really powerful idea called the 70-30 move. It's actually pretty simple. The idea is that your decision on where to live should be like 70% driven by your career and only 30% by the actual geography. You've got to follow the opportunity because your job, your income, that's your number one moneymaker, especially when you're just starting out. And this right here is exactly why that makes sense. Think about it. Expensive cities aren't expensive just for kicks. They're pricey because that's where the incomes are high and the opportunities are packed in tight. A high cost of living isn't just a bill, it's a signal of a booming economy.
I mean, take a look at the story of Yelp's co-founder, Jeremy Stoppelman. When asked about his success, what did he say? Moving to San Francisco and a lot of luck. Just by being in the right place at the right time, he connected with the people who would become his partners, his investors. That's the network effect, right there in action. It's just powerful.
Okay, but the big question is, can you actually afford it? Well, take a look at this. This is the author's actual budget from back in 1999, trying to make it in Manhattan on a $40,000 salary. And check this out, by splitting a tiny studio and, grabbing free dinners at the office, he was still able to max out his 401k.
The whole point is just to survive that initial sticker shock until your income starts to climb and catch up.
Now let's compare that to living a bit more comfortably in a cheaper city like DC. Yeah, the leftover cash flow looks better for sure. But what's the trade-off? You're missing out on those unique high-density opportunities. You're basically trading a little bit of comfort for a shot at a much, much bigger financial win. All right, let's keep it moving and tackle myth number 2. This one's a big one, that romantic but honestly financially dangerous idea of finding your one and only forever home. So here's the key. You've got to shift your entire mindset. Stop looking for a place to live forever. Instead, you need to buy with the intention to own forever. See the difference? You treat every property you buy as a potential long-term asset, something that could one day generate passive income for you, even if you personally have moved on. And you know what? The author's own life is the perfect example of why this is so important. Look at this timeline. He bought his first quote-unquote forever home in 2005. But then life happens, right? He downsized. Then he had a son, which changed everything. Then he had a daughter. And boom, he's buying a third forever home just to get more space. Life is just way too unpredictable for one single house to fit every chapter. And the numbers totally back this up. I mean, while the ideal holding period for an asset is, well, forever, the reality is that the average person only stays in their home for about 10 years. That's it. This makes having a flexible, long-term strategy absolutely crucial. Okay, so we've picked a city and we've ditched the forever home myth for a forever asset mindset. So now let's zoom in a little closer to the neighborhood level and bust our third myth, the idea that you always have to stretch to buy in the absolute best, most expensive area. Here's the hard truth. If you really want to fast-track your journey to financial freedom, you have to squash that little voice in your head, that ego-driven desire for a fancy house in a prime neighborhood. Real wealth isn't built by overpaying for what's popular today. No, it's built by finding the hidden gems, the value of tomorrow. And the cool thing is, you don't need a crystal ball to do this. You can become your own neighborhood analyst just by looking for some simple, concrete signs. Are new restaurants and grocery stores popping up? Is a big company moving a new campus into the area? These are telltale signs that a neighborhood is about to take off. Now, here's a really cool tool you can use to analyze pricing. It's called the frenzy zone. This is basically the price range where all the action is, where everyone is competing. Usually the median home price plus or minus about 20%. But here's the pro tip. If you can afford to look just above that zone, maybe 21 to 30% above the median, the competition often drops off a cliff. And that's where you can find a much better deal. Okay, on to the final piece of the puzzle. What type of property should you actually buy? We figured out where to look, but the what is just as important. And look, there is no single right answer here. It's not one size fits all. The best choice for you depends entirely on your financial goals, the kind of lifestyle you're after, and frankly, how much hands-on work you're willing to do. It's a strategic choice, not just an emotional one. And this table here lays out the trade-offs perfectly. A single-family home? Yeah. It's great for lifestyle, for privacy, and it has awesome appreciation potential. A condo? It's more affordable, way lower maintenance, but you've got HOA fees and maybe less appreciation. But if your number one goal is maximizing your income, then a multi-unit property is, without a doubt, the most powerful financial tool in the box, even if it means being a more active landlord. All right, so let's tie all of these big, kind of counterintuitive ideas together into a clear, actionable blueprint that you can actually use for your next real estate move. So here it is, your blueprint. Number 1, maximize your income first. Remember that 70-30 rule and go where the opportunity is. 2, buy with the intent to own forever and slowly build that rental portfolio over time. 3, a big one, try to keep your housing costs under 20% of your gross income. This keeps you financially nimble. 4, hunt for value. Look in those up-and-coming neighborhoods, not just the fancy ones. And finally, number 5, align what you buy with your main goal. If you want maximum income, get a multi-unit. If it's all about lifestyle, a single-family home is your best bet. Look, at the end of the day, your home is always going to be your shelter. That's a given. But the real question is this. Are you going to let it be just an expense, or are you going to make it your greatest engine for building wealth? The choice really is yours. You know, think about your financial future for a second. What does it look like? Is it a fortress? A solid, real structure that can protect your wealth from, all the craziness in the market and the curveballs life throws at you? Well, that's the powerful idea we're going to dig into today. So let's jump right in. We're breaking down some of the big ideas from Sam Dogen's book, Buy This, Not That. We're really going to focus on his argument for why going long on real estate can be one of the best ways for a regular person to build some serious, lasting wealth. And here's how we're going to do it. First, we'll talk about why real estate can actually beat stocks. Then we'll look at it as a kind of security blanket. We'll compare getting your hands dirty with physical property versus investing online, look at a huge trend in the heartland, cover some essential rules, and then wrap it all up with how you can build your own financial fortress. Okay, Section 1, the real estate advantage. Let's tackle that big, juicy question. How can a physical house possibly generate bigger returns than the stock market? I mean, it's a fair question, isn't it? We're always told stocks are the engine of growth. So how can something you can literally walk up and touch, which seems so much slower, actually win the race? Well, the answer really comes down to human psychology and confidence. Let's start with a little data. Back in 2019, the median stock portfolio for an American family was just $40,000. Think about that. That's the amount of money the average person feels okay with risking in the market. Now compare that to real estate. The median home price in 2022, $400,000. That is 10 times more. People are willing to put way, way more capital into a house. And why? Because it's real, it's tangible, it's your shelter. And this is where it all clicks. To make $40,000 in profit, that $40,000 stock portfolio has to double. That's a 100% gain. But your house, it only needs to go up by 10% to get you the exact same 40 grand return in your pocket. That's the incredible power of investing more capital with confidence. The author, Sam Dogen, puts it perfectly. It's that confidence, that gut feeling that your investment isn't just going to vanish overnight, that makes people comfortable taking on more leverage. And that willingness to go bigger, that's the secret sauce. So this next part gets to the real heart of the matter. Real estate is so much more than numbers on a page. It's about security. It's about having some control in a world that, let's be honest, can feel pretty unfair sometimes. Now, have a look at this data from Facebook. The author's point here is that in these super competitive corporate worlds, it can be really tough to get ahead. And for a lot of people, seeing numbers like this just reinforces that feeling that maybe the system isn't really built for them, which makes relying only on a W-2 job feel pretty risky. And that leads to this really powerful idea. Dogen calls real estate a permissionless business. You don't need a manager to promote you or a gatekeeper to say yes. You can just decide to participate in the economy and benefit from its growth by owning a piece of it yourself. Okay, so you're on board with the idea, but how do you actually do it? That brings us to our third section, choosing your path, whether that's physical property or investing online. Let's break it down. On one hand, you've got physical property. You have all the control, it provides real security for your family, but yeah, it's a lot of work. On the other hand, you have online stuff like REITs, which are real estate investment trusts. They're totally passive, you can spread your money all over the country with just a few bucks, but you do give up that hands-on control. And you know, there's this incredible, intangible benefit to owning physical property that you just can't get from a stock ticker. The author tells this great story about planting trees with his son at a rental property, teaching him about responsibility and real, tangible assets. It's a great reminder that this is about building a legacy, not just a spreadsheet. Okay, so where should you be looking to invest? This brings us to a massive trend. Dogen's argument is that if you want to build real wealth, you have to skate to where the puck is going, and right now, all signs are pointing to the American heartland. So what's behind this so-called heartland gold rush? It's a perfect storm of factors. You've got the explosion of remote work, letting people ditch expensive coastal cities, and you've big money following them, chasing better returns. The result? You're seeing potential rental yields that are 3, 4, even 5 times higher than what you could get in a place like San Francisco or New York. All right, let's get into the nuts and bolts. Section 5 is the investor's rulebook. These are the gotta-know-it rules that'll help you make smart moves and, just as importantly, avoid really costly mistakes. First up, and this is a big one, vacation homes. The author's rule is super strict. Do not spend more than 10% of your net worth on one. Why? Because a vacation home is a lifestyle asset, not a financial one. He even admits he learned this the hard way, buying a property that was over 30% of his net worth and causing a ton of financial stress. Now, when you're sizing up a potential investment, you can't just go with your gut. You need a process. Here's a simple 4-step version of the author's method. First, figure out your gross rental yield. Second, find the cap rate. We'll talk more about that in a sec. Third, you got to run different scenarios. Best case, worst case, and realistic. And finally, always check the comps, see what similar places have sold for recently. So, that cap rate we just mentioned? Don't let the fancy name scare you. It stands for capitalization rate, and it's actually super simple. It's just your annual rental income minus your operating costs, all divided by the property's price. It's an awesome way to quickly compare the potential return of one property versus another. And generally, a higher cap rate is a good thing.
All right, that brings us to our conclusion, putting all these pieces together so you can start building your own financial castle, the financial samurai way. So what are the big things to remember from all this? First, think of real estate as your career insurance. Second, bet on huge long-term trends like the move to the heartland. Third, get your hands dirty with physical property while you've got the youth and energy. Fourth, never ever skip the math. And finally, remember that the whole point of this isn't just to make money, it's to take control of your own destiny.
We started with that image of a fortress, and that's exactly where we'll end. This is all about building something strong, something lasting for your financial life. So the only question left is, how are you going to build yours?
Most of us just see our career as, a job. It's how we pay the bills. But what if I told you you're looking at it all wrong? What if your career is actually the single most powerful financial asset you will ever own? An asset that, if you play your cards right, can be managed, optimized, and grown with a clear strategy. Let's really dig into that. And this, right here, really gets to the heart of it. That clock is always ticking, isn't it? Every single day, we trade our precious time for something in return. But for what? Is it just a paycheck? Is it for a passion? This is the core conflict we're going to unpack. That constant, critical trade-off between our time, our money, and, well, our passion. And look, the stakes could not be higher. As author Sam Dogen puts it, your career is the engine that's going to fund everything else in your life. Your investments, your savings, your entire financial freedom. The decisions you make, especially early on, they have this massive compounding effect over your lifetime. So yeah, no pressure, right? All right, here's our game plan. First, we're going to learn how to think like an investor when it comes to your career. Then, we're going to bust 3 huge career myths: the whole passion versus paycheck debate, the startup dream versus a stable job, and whether loyalty pays or if job hopping is the way to go. And finally, we'll put it all together into a strategic playbook that you can actually use. Okay, first things first, we have to completely reframe how we look at our professional lives. Your career isn't just a series of jobs. It is the single biggest investment you will ever make. Think of it like a money machine, designed to generate capital for decades to come. So, thinking like an investor means you have to look way beyond just the base salary. It means you got to analyze the entire compensation package. And one of the most powerful, but let's be honest, most ignored parts of that is the pension. It might not sound sexy or exciting, but its true financial value is absolutely staggering. So what's with this $2 million? Well, think about it like this. To reliably generate $50,000 a year in passive income, you'd need about $2 million in capital just sitting in an investment account. That means a job that offers you a $50,000 pension isn't just a nice little perk, it's the financial equivalent of someone handing you a $2 million asset. That is the kind of investor-level thinking we need to apply here.
All right, let's tackle one of the most common pieces of career advice out there. I mean, we've all heard it a million times, but is it actually good financial advice?
And there it is. Follow your passion. It sounds so wonderful, so inspiring, doesn't it? But the hard reality is that turning what you love into your profession can be a brutal process, one with a very, very low probability of financial success. A more pragmatic approach is often way more effective.
Let's just take the author of our source material, Sam Dogen. His dream was to be a professional tennis player, but he was also realistic about the incredibly slim odds of making it big. So what did he do? He made a strategic choice: go for a high-paying career in finance, and then use that income to fund his passion for tennis as a really competitive hobby.
And here's the crucial takeaway from that. A stable, high-paying job can give you the financial freedom to pursue your passions without the crushing pressure of needing them to pay your rent. You get to separate your joy from your income, which, ironically, often lets you enjoy your passion even more. And speaking of passion, let's talk about the ultimate passion play in the career world, the startup. It's often painted as this super fast path to getting rich, but let's look at the actual numbers behind that Silicon Valley lottery ticket. Which brings us right to myth number 2. We've all seen the headlines, right? The stories about early employees becoming overnight millionaires. The media just loves a winner. But that whole narrative conveniently leaves out the huge silent majority of startups that just don't make it. Okay, let's make this super concrete with the comparison from our source. On one side, you've got the sexy startup offer, a lower salary, but hey, you get the potential of valuable stock options. On the other side, you have a stable corporate giant like Procter & Gamble, offering a much higher salary plus guaranteed stock grants every single year.
So just take a second. Which one of these two paths do you think actually builds more wealth over 5 years? I think the numbers might surprise you.
First up, the stable path. At Procter & Gamble, that employee earns $1.25 million in salary plus another $250,000 in stock grants over 5 years. That's a guaranteed grand total of $1.5 million. It's solid, it's predictable, it's substantial. That's our baseline.
Now, let's look at the startup. We can't just look at the best-case scenario. That's not how it works. We have to look at the probabilities. And the experts in this game, the venture capitalists, they only expect about 1 in 10 of their investments to be a real home run. The rest, they either go bust completely or they become these zombie companies, just kind of treading water, not really going anywhere.
So when you actually calculate what's called the expected value of the startup offer, which means you factor in that 50% chance of just being mediocre, the 40% chance of total failure, and that tiny 10% chance of a huge win, the total value comes out to just $800,000. That is $700,000 less than the stable P&G route. The startup path isn't a financial plan. It's a lottery ticket. All right, on to our final myth. And this one goes against decades of conventional wisdom. We're often taught that company loyalty is a virtue. But in today's world, what's the actual price you pay for staying put?
Well, it's a concept known as the loyalty discount, and it's exactly what it sounds like. See, companies are incentivized to pay you just enough to keep you from walking out the door. So when you stay for years and years, your salary often falls way behind what the open market would pay for your skills. The biggest raises almost always come from changing companies.
This slide just illustrates the point perfectly. On one side, you have John Wooden, the legendary UCLA basketball coach. Famously loyal, he never made more than what would be about $185,000 a year today. On the other side, you've got football coach Nick Saban, who strategically moved between teams, leveraging his success into massive contracts worth over $84 million. The lesson is crystal clear. If you're good at what you do, job hopping pays off.
So we've debunked the myths. We've looked at the numbers. Now let's put it all together into an actual strategy. It's time to build your personal career playbook.
Now this phrase, career selfish, it might sound a little harsh, but it is absolutely necessary. Think about it. Your employer's job is to maximize value for the company. Your job is to maximize value for yourself and for your family. And you have to remember those two interests are not always aligned.
So here it is, the playbook. Number 1, target industries that pay well from day one. Don't start in a low-paying field hoping to catch up. Number 2, treat that startup equity as a high-risk lottery ticket, not a retirement plan. Number 3, to beat the loyalty discount, plan on changing jobs every 2 to 5 years, especially early in your career, to reset your salary and your title. And number 4, the most important rule of all, your primary loyalty is not to a company, it's to your own financial future and your family.
At the end of the day, your career is your money machine. It is your #1 wealth-building asset. It's a game with clear rules and some very clear winning strategies. The only question is, now that you know them, how are you going to play?
You know, most of us have a job, but how many of us have a real career strategy? It's the difference between just showing up every day and actually building your future on your own terms. Today, we're diving into a really powerful way of thinking about not just making your money, but making your exit.
So let me just ask you something right off the bat. What's your career exit strategy? I'm not talking about your next job. I mean your ultimate departure, the end game. If you're drawing a blank, don't worry, you're in exactly the right place.
The author of our source material, Sam Dogen from Financial Samurai, he puts it like this. Your career isn't just a bunch of tasks you do from 9 to 5. It's a battlefield. And on a battlefield, you can't just work hard. You've got to have a strategy to navigate it, to survive, and ultimately to win.
So, where does a strategy like that even begin? Well, it starts by building a rock-solid foundation.
The goal isn't just to be a good employee, it's to become someone they absolutely cannot afford to lose.
And this, right here, is a crucial mindset shift. The source argues that this idea of a pure meritocracy, it's pretty much dead in the corporate world. Like the slide says, being a great worker simply isn't enough. Believing that just doing good work is going to get you promoted, that's a mistake a lot of us make.
So how do you build that kind of leverage, especially when you're just starting out? The advice for people in their 20s is, well, it's pretty blunt. Get there before your boss and leave after they do. Forget work-life balance for just a little while and focus on out-hustling everybody. You want to become so good, so vital to the team, that the very thought of you leaving actually causes your manager pain. Okay, so you've become a top performer. You're a rock star. But your technical skill, that's only half the battle. To actually get promoted, to get paid what you're really worth, you have to master the art of politics. You've got to play the game to win. Now, this isn't about backstabbing or being shady. It's about building a whole network of people who support you. The source lays out 5 key strategies. Treat your coworkers like they're your clients. Help your boss get ahead first. Make real connections with senior leaders. Find common ground with everybody. And always treat junior colleagues with respect. It's about creating these relationships where everyone kind of wants to see you succeed.
What's really cool is how practical this advice is. The author tells this story from when he was at Goldman Sachs. He systematically emailed every single senior leader and invited them for lunch or a drink. And he paid for it, just to listen and see how he could help them. And here's the kicker. Nobody said no. It's a great reminder that the people at the top, they're just people. You just have to be willing to connect.
Okay, this brings us to a delicate subject. The source kind of redefines what some people might call brown-nosing. He calls it the strategic art of building commonality. Look, it's not about being fake, it's just about being smart. Defensively, you avoid picking fights with your boss over their core beliefs. And offensively, you find genuine common ground, whether it's their favorite football team or a TV show they love. It's just about building a real connection. Of course, your career doesn't exist in a vacuum. Life happens, right? And one of the biggest crossroads any of us face is when our professional dreams slam right into starting a family. This is a dilemma that so many working parents wrestle with. It feels like an impossible choice, doesn't it? You want to be a fantastic parent, you want to be there for your kids' early years, but you also want to be a great employee and keep your career and your finances moving forward. It feels like something's got to give. To fight that overwhelming guilt that so many parents feel, the source offers a data-driven solution. Just look at the averages. University-educated moms spend about 120 minutes a day with their kids. Dads, about 85 minutes. The whole idea is, if you can just beat these numbers, you can give yourself permission to feel like you're doing an above-average job. It's just a mental trick to manage that guilt.
So what's the optimal solution here? The book suggests this 70-30 combo. One partner keeps working full-time, keeping things stable financially. The other partner takes a 2 to 3 year break to be a full-time parent. And here's the crucial part. A break that short is not long enough to completely kill your career, especially now when work is so much more flexible.
And this brings us to the final act. And honestly, this might be the most powerful, most counterintuitive idea in this entire strategy. Mastering your departure. It's not just about how you work, it's about how you leave. You gotta love how the author puts this. A baby panda dies in the woods every time you quit your job or get fired. And why does he say that? Because quitting your job is a massive financial mistake. You are leaving a huge pile of money and benefits on the table.
Okay, let's break this down, because this slide is absolutely critical. When you quit, you get nothing. 0 severance. You probably won't get unemployment benefits. You lose your deferred compensation. And you have to pay for your own expensive health insurance. But if you negotiate a layoff, you can get all of it. The financial difference is just staggering.
So here's the key. You don't just wait around to get laid off. You engineer your own layoff. You go to your boss with a plan for a long, smooth transition. You show them you care about their needs, and this turns your departure from being a problem for them into a win-win solution where they save on your salary and you get to leave with a nice package. And does this really work? Is this just a crazy theory? Well, this slide says it all. The author used this exact strategy to negotiate a severance package that covered 5 to 6 years of his living expenses. For him, this wasn't just an idea, it was his ticket to financial freedom.
So let's just recap the financial samurai way. First, sell yourself internally. Your coworkers and your boss are your most important clients. Second, if you're a parent,
beat the average time spent with your kids and cut yourself some slack. Third, remember, a 2 to 3 year parenting break is not a career killer. And finally, the golden rule: never, ever quit. Engineer your layoff instead.
And that really brings us to our final thought. Sooner or later, your career is going to end. The only question is, will it be on your terms? This whole strategy is about taking control of that final and most critical step.
All right, let's get right into it. Are you feeling kind of stuck in that 9 to 5 grind? You know, dreaming of a little more, well, a lot more financial freedom? Today, we're going to break down the one thing that could seriously be your ticket out: the side hustle. And look, it's not just about making a little extra cash on the side. This is about taking back control and actually building a future that you design. You know, think of your whole financial plan like a car, right? Your day job, that's the engine. Your savings, that's the fuel in the tank. But a side hustle? Now that is the turbocharger. It is the absolute game changer that can just rocket you towards your goals. It puts you in the driver's seat, gives you control over the steering wheel of your life, and let's be honest, a day job almost never gives you that.
And this quote, this is really the heart and soul of the hustler's mindset. Work while others are sleeping so you can eventually play while others are working. I mean, wow. It's all about that short-term trade-off, isn't it? You sacrifice a little bit of that downtime now for a whole lifetime of freedom later on. So let's really keep that idea in our heads as we dive deeper. So, your financial X factor, why a 9 to 5 just isn't always going to cut it. You know, that whole idea of building for the future, it's more important now than like ever before. So let's really dig into why this X factor is so critical. I mean, in today's economy, just relying on a single paycheck, that is a very risky game to play. A side hustle, that's your secret weapon, your strategic advantage. And the inspiration for Financial Samurai, which is where we're pulling this from, actually came from a simple jog. No joke. Picture this. The author Sam Dogen is out for a run in San Francisco, jogging past these absolutely incredible mansions. And then it hits him, this powerful thought. These homes, they don't belong to bankers or lawyers. They belong to entrepreneurs. And in that moment, he realized his day job, as good as it was never going to get him that. And boom, that's when the seed for his own online platform was planted. Okay, I can practically hear you through the screen right now. You're thinking, are you kidding me? I'm already wiped out from my 40-hour week. Where on earth am I supposed to find the time for this? And look, that is a totally valid concern. It's probably the #1 reason people never even start. But what if I told you the data tells a completely different story? Seriously, just look at this chart. It is fascinating stuff. The data actually shows that the average American is working fewer hours per week than they were decades ago. So what does that mean? It means that hurdle to get ahead, to find those extra 5 to 10 hours a week, it's actually lower than most of us think. The opportunity is right there, just ripe for the taking. All right, before we even get into the what to do, we have to talk about how to think. Because let me tell you, success in this old side hustle game, it isn't just about having a great idea. It's about having the right mindset, the grit to see it through when things inevitably get tough. Okay, so here they are, the 4 pillars of the hustler's mindset. #1, just start now. Don't wait for permission. Don't wait till you feel ready. There are no gatekeepers here. #2, show up consistently. Seriously, this is your secret weapon. Most people give up. You won't. Third, you got to make some sacrifices. It's that simple. Trade a few seasons of that show you're binging now for a lifetime of freedom later. And finally, #4, take risks and adapt. You have to step out of your comfort zone and be willing to learn as you go. Okay, so you've got the right mindset locked in. Awesome. Now, what's the actual plan? Well, you've got a really crucial choice to make right at the beginning. There are 2 very different paths you can take to start earning that extra income. So on one side, you've got your classic side gigs, driving for a rideshare, freelance writing, that kind of thing. And they're great for making some quick cash, for sure. But the catch is, you're still just trading your time for money. On the other side, you can build your own brand. We're talking a blog, a course, maybe a YouTube channel. See, this isn't just another job. You're building an asset, something that can literally make you money while you sleep. And that is the path to real long-term wealth. And if you want to see the incredible power of building a brand, just look at these numbers. This is what's possible. Year 1, yeah, it might only be a couple $1,000. It is a grind, no doubt about it. But if you stick with it, by year 5, you could be looking at well into the 6 figures. And by year 10, we're talking $500,000, maybe even over $1 million.
The absolute key here is that unwavering commitment, especially in that brutal first year where, honestly, most people just give up. And listen, these are not just some made-up numbers on a spreadsheet. These are real-life examples. You've got Harry, an engineer who started a blog for rideshare drivers and turned it into a business that makes over $1 million a year. You have Sherry, who turned dog walking into $3,000 a month and used it to buy a condo. And Matt, who took his knowledge from working at a pool supply store, built a website, and now pulls in over $450,000 a year in profit. These are real people who just chose a path and, most importantly, stuck with it. Which, of course, leads us to the ultimate question, the one every successful side hustler eventually has to ask themselves. When is it time to quit the day job? When do I go all in on this thing? It is a huge, huge decision, so let's break down a solid framework to help you make that call. Now, here is a crucial mistake, like a rookie mistake that so many aspiring entrepreneurs make. They think if my side hustle makes what my salary makes, I can quit. But they forget that their salary is just one piece of the pie. Your day job comes with a ton of hidden financial benefits. So to really, truly go solo, your side hustle needs to be making significantly more than your base salary just to cover all that stuff. Let's just break it down with a simple example. Say you make $100,000 a year. Well, you've also got your company's 401k match, that's like free money. You've got subsidized healthcare, which is huge, paid vacation. When you actually add it all up, that $100,000 a year job is really worth more like $132,000. And that's not even counting all the new stuff you'll have to pay for as a business owner, like higher taxes, new equipment, you name it. So how do you know you're really onto something? Here's your first big milestone to aim for. When your side hustle is consistently bringing in 25% of your day job salary. Once you hit that, you know you've officially moved past the hobby stage. You're building some real, serious momentum now. Okay, next up, 50%. This is where things get really exciting. At this point, you've proven the concept. You know you've got something with massive potential on your hands. This is the moment you need to set a hard goal for yourself. I'm going to get to the next level in the next 6 months, period. Then you hit 75%. Now it's decision time, for real. If you're a bit of a risk taker, hey, this could be your moment to just leap. But if you're more cautious, that's totally fine. Just pick a date on the calendar, maybe 6 months out. And if your income is still just as strong or stronger by then, well, it's time to start typing up that resignation letter. And then, the moment you have been grinding for, your side hustle is now making 100% of what your day job brings in. First of all, congratulations, that is incredible. But now you have to realize your day job is officially holding you back. It's time to go all in and see what you can really do. So we've talked a lot about the how to start, how to grow, when to quit. But now let's talk about the why. Because once you achieve this incredible freedom, you're faced with another big choice. What kind of life, what kind of entrepreneurial life do you actually want to live? And you can think of it like a choice at the poker table. Option 1, the lifestyle business. You're working maybe 2 to 4 hours a day, pulling in a fantastic, consistent income, maybe 15, 20, 30 grand a month. Or option 2, the big payout. You're working 12 plus hours a day, grinding it out for a tiny chance at a massive, life-changing payout, but also with a very high chance of failure, of ending up with nothing. Which one is for you? And that really just gets to the heart of the whole thing, doesn't it? The ultimate prize here isn't just about having a bigger bank account, it's about designing a life that is truly yours, on your terms. And for most people, I think, that is the real definition of winning. All right, so let's bring it all home with the key takeaways from the Financial Samurai Way. First, start seeing your free time, especially your weekends, not just as time off, but as your prime time to build the life you actually want. Second, do not wait until you're an expert. Just start. You'll figure it out as you go. And finally, remember this, that intense, hard work at the beginning, it won't last forever. But the results, the freedom you build, that just might. Because in the end, this whole journey is about so much more than just the money. It's about creating options. It's about autonomy. It's about having total control over your own time. It's about freedom. So the real question I want to leave you with isn't, can you do this? It's, what are you going to do with your freedom once you've earned it?
Welcome to The Explainer. Today, we're diving into one of the biggest, most significant financial decisions you'll probably ever make, investing in education.
We're going to tackle this whole thing by focusing on one really powerful question. Let's just forget about the bragging rights and the fancy alumni networks for a minute. We're going to look at this through the cold, hard lens of your financial future.
Because what if I told you that the real cost of a private education isn't just the tuition? What if it's actually the opportunity to have over $1 million sitting in your investment account instead? Yeah, in this explainer, we're going to show you exactly how that number comes to life.
Okay, let's dive in. Here's our game plan. We'll start by busting the myth of prestige. Then we'll run the numbers on public versus private, uncover that $1 million opportunity cost, look at some smart savings tools, touch on grad school, and finally, figure out what the ultimate return on investment really is.
First things first, let's talk about the allure of that elite diploma. You know the one. The source for today's explainer argues that its value has a surprisingly short shelf life.
So here's the crucial point. A top school might help you get in the door for that very first job interview. But after that, your success really hinges on your performance, your skills, and what you can actually do. The name on that degree, it quickly becomes a footnote.
And this story just nails the point home. The author, Sam Dogen, didn't go to an Ivy League school. He got his foot in the door at Goldman Sachs through sheer grit, waking up at the crack of dawn, studying the markets, and just flat out hustling the competition. Your actions can often speak a whole lot louder than your alma mater.
Okay, so let's get to the core of this whole debate and see how this all stacks up financially. We're going to put public and private schools head to head.
So you've got almost 80% of undergrads attending public schools, and for good reason. They offer a fantastic return on investment. Private schools, on the other hand, well, they come with a seriously hefty price tag. So how do you even know if you can afford one without totally sabotaging your financial future?
Well, the author suggests a really simple but powerful guideline. If the annual net tuition is, say, $30,000, your household should be making at least $210,000 to comfortably afford it. This rule helps ground what can be a really emotional choice in a clear financial reality.
Now, this is where it gets really interesting. Check out this data from Georgetown University. It shows that over an entire career, a private college degree holder earns, on average, just $73,000 more than a public college graduate. I mean, when you weigh that small difference against the massive difference in cost, the math gets pretty compelling, doesn't it?
And that surprisingly small earnings difference leads us right to the most critical part of this whole framework: understanding what you are truly giving up when you pay for that private education.
Let's just look at the raw numbers for a full private education in a city like San Francisco. The total tuition comes out to almost $750,000. But wait, here's the real story. If you took that same money and invested it with a pretty conservative 5% annual return, it would grow to over $1.1 million.
So this is the ultimate choice. It's not really about public versus private. It's about what you could do with that capital. $1 million head start in life versus a prestigious diploma. This reframes the entire decision, doesn't it?
Now, regardless of which path you choose, if you are saving for education, there is one tool that absolutely stands out above all the rest.
It's the 529 plan, and it is a total no-brainer. And here's why. Your money grows completely tax-free, and you can withdraw it tax-free for any qualified expenses. That double tax benefit is what lets compounding work its magic without the government taking a cut. It is an incredibly powerful way to save for this specific goal.
And the 529 plan has gotten way more flexible than it used to be. Thanks to some recent legislation, you can now use it for K-12 tuition, apprenticeship programs, and you can even use it to pay down a limited amount of student loans. It's really evolving into a much broader educational savings tool.
Okay, so what about grad school? Is that 2-year, 6-figure investment in an MBA still the golden ticket it was once cracked up to be?
I mean, with tuition at top programs soaring past $150,000, and that's not even including the 2 years of lost income, the author argues a full-time MBA only makes sense in a few specific scenarios. The absolute best case? Getting your employer to foot the bill.
And what's interesting is the author says his biggest ROI from his Berkeley MBA wasn't just the salary bump. It was the confidence to hold his own in those high-level financial meetings. You know, sometimes the return isn't just about the money, but about gaining that capital to feel like you belong in the rooms where the big decisions are made.
So, after all this analysis, after we've looked at the prestige trap, run the numbers, and seen the opportunity costs, what is the final takeaway? What's the smartest way to think about investing in education?
It really comes down to a shift in your mindset. The goal isn't just to get the best degree, it's to build the best life. And that means prioritizing a safe, nurturing learning environment and making choices that enhance rather than jeopardize your family's long-term financial freedom.
Because at the end of the day, whether it's through a public university, a trade school, online courses, or just reading a great book, the greatest return comes from staying curious and believing that there is always something more to learn. The real investment is in yourself for a lifetime.
You know, we're always told to keep love and money in separate boxes. One's all about emotion, the other's about cold, hard logic. But what if that's totally wrong? What if the most logical, rational financial moves you can make are actually the most romantic ones? Well, that's what we're going to explore today, applying a really smart financial framework to the biggest, most emotional decisions of our lives.
So let's start with this classic dilemma: rich and alone, or poor but in love. The source material we're digging into today argues this is a total trick question. Because let's be real, either option kind of stinks. The real goal isn't to pick one over the other. It's to figure out how to have both. Because when your love life and your money are constantly fighting, that stress, it's just a killer.
And the stakes here are incredibly high. I mean, just look at this number. Financial problems are a factor in 36% of divorces. That is a massive, massive number. It just goes to show you that getting on the same page about money isn't just a nice to have, it's absolutely critical for making a relationship last.
So how in the world do we navigate all this? Well, the author of our source material has this brilliant framework called the 70-30 principle. The whole idea is to stop chasing 100% certainty, because let's face it, that's impossible. Instead, you just try to make the choice that has at least a 70% chance of working out well. It's all about playing the odds in your favor for your money and your love life.
Okay, let's put this principle into action. First up, one of the biggest decisions you'll ever make. We're going to look at marriage, but strictly through a financial lens.
So here's the big question. From a pure dollars and cents perspective, are you better off getting legally married or just living together forever? It turns out the answer really boils down to two key things: taxes and Social Security.
And this breaks it down perfectly. Okay, so with marriage, if you're both high earners, you might get hit with what's called a marriage tax penalty. Bummer. But on the flip side, you get access to Social Security spousal benefits, which could be up to 50% of your partner's benefit. That is a huge financial safety net. If you just live together, you get zero access to that. None. So when you actually crunch the numbers, the 70-30 conclusion is pretty clear. For the partner who earns less or has fewer assets, getting married is almost always the smart move. That access to benefits provides a massive layer of financial security for the long haul.
All right, so you've decided to tie the knot. Fantastic. Now comes the next major financial hurdle, the wedding itself. Or, as the source calls it, the one-day party problem. Get this, back in 2021, the average wedding in the U.S. cost $22,500. For the typical American household, that's nearly 40% of their entire after-tax income for one single day.
But here's the real kicker. That 22 grand isn't the true cost. The true cost is what that money could have become. If you had invested that cash instead with an average 8% return, in 20 years it would have grown to over $104,000. That right there is the opportunity cost of that one big party.
So to avoid starting your marriage in a financial hole, the source lays out a few simple rules, like spend no more than 10% of your combined income. Or, and I love this one, spend no more than half of what you earn from your side hustles. And of course, there's always the classic, spend only what your parents are willing to kick in, as long as there are no strings attached. Now, what about after the I do's? How do you actually manage money as a team every single day and tackle those huge decisions, like having kids?
You know, one of the biggest points of friction for couples is spending. So the author suggests a 3-account system. You have one joint account for all the shared stuff, rent, bills, groceries, but then you each have your own separate personal account. This setup is a total game changer. It's a release valve so you can buy stuff without feeling guilty, an insurance policy if things go south, and it even motivates you both to earn and save more.
And if you need proof of why that financial autonomy is so important, just read this quote. This woman felt like she couldn't even spend money on a massage for her own well-being without having to justify it. Having her own no-questions-asked money would have given her the freedom to take care of herself without that fear and guilt.
This brings us to probably the biggest decision a couple can make.
Should you have kids when you're young, full of energy, but maybe short on cash? Or wait until you're older and more financially stable? It's that classic tug-of-war between biology and your bank account.
So, is there a 70-30 answer? A best age? Well, according to the analysis, the number to aim for is 32. It's this sort of strategic sweet spot. By 32, you've probably had about a decade to get your career and finances in order, but biologically, you're still in a great position. It's the best of both worlds.
Of course, not every story ends with happily ever after. And even for the ones that do, a whole new set of financial questions pop up when your kids become adults. So we've got to talk about the tough stuff, endings and legacies.
To talk about divorce logically, you first have to understand this thing called the sunk cost fallacy. We all do this. It's when you keep doing something you know is a bad idea, like watching a terrible movie to the end, just because you've already invested time or money into it.
And this is its most painful application. Staying in an unhappy marriage after you've tried everything, simply because of all the years you've put in, that is a textbook sunk cost fallacy. The truly rational 70-30 move is to recognize that the past is the past, cut your losses, and move toward a happier future.
And what about your legacy with your kids? If you're in a position to help your adult children financially, the source says to do it with clear boundaries. Treat it like a real loan, with interest and a deadline. This isn't about being mean, it's about making sure they still value the money and stay motivated. It's a hand up, not a handout.
Okay, let's wrap all this up. Let's bring it back to that core idea and figure out how you can find your own optimal 70-30 path when it comes to love and money. When you boil it all down, it comes to this. Your partner is either your financial teammate or they're your financial opponent. There's really no in between. The entire goal of this 70-30 framework is to get you both on the same team with your love and your money working together to build a better life.
Which leaves us with one final, very personal question. I want you to think about your own situation, your own relationship, and ask yourself this, honestly, are your love and your money goals truly aligned?
Okay, what if I told you the secret to real financial freedom wasn't about getting a bigger number in your bank account, but about disappearing completely? Today, we're diving into a pretty radical idea, stealth wealth, which is basically the art of being rich without anyone having a clue. It's a weird thing to think about, right? We all assume that millions of dollars would solve all our problems and bring instant happiness. But a lot of the time, it's the total opposite. I mean, you can have people worth hundreds of millions who are just completely miserable. Why? Because they're trapped by their own success. They're bogged down by shareholder meetings, employee drama, and just this crushing weight of responsibility. They've got the money, sure, but they've completely lost control over their own time. And that, right there, gets to the absolute heart of it. We're not chasing financial freedom just for the money. The real prize, the thing we're actually after, is the freedom part of that equation. The ability to make our time 100% our own. So what's stopping us from getting that freedom? Well, one of the biggest traps out there is what's called the status game. It's this endless treadmill of spending money on things we don't even really care about, all to get a thumbs up from people who, let's be honest, don't really matter. It's a game that can keep even the richest people from ever being truly free. Think about it like this. On one side, you have the rich and famous. Yeah, they get a ton of attention, but their time just shrinks because everyone wants a piece of them. Then on the other side, you've got the rich nobody. This person focuses on the fortune, not the fame. And because of that, they can move their society completely freely. Their time is their own, and that is the ultimate luxury. So the way you escape this status trap is with this concept called stealth wealth. It's really just the art of blending in. By keeping your financial success private, you get to skillfully sidestep all that judgment and unwanted attention, which in turn protects your two most valuable assets, your time and your freedom. Now, going down this path really requires a pretty fundamental shift in how you think about money and success. This isn't just about a few tips and tricks, we're talking about a completely different philosophy for how to live your life. And here's the core difference in that philosophy. The status game is all about external validation, buying stuff to impress other people. But the stealth path, that's all about internal satisfaction. It's about buying quality things for your own pleasure and focusing your energy on chasing freedom and time, not prestige. Okay, so the philosophy makes sense, but how do you actually
do this? How do you put it into practice? Well, let's get into the playbook, which is built on 3 core disciplines. It all really boils down to these 3 key areas. First, how you manage your physical stuff. Second, how you protect your personal and financial information. And third, maybe the most important of all, how you master your own attitude and how you present yourself to the world. Now, guarding your information might sound a little paranoid, but it has some crazy real-world consequences. Get this. There was a preschool that sent staff to drop off welcome bags to new parents. But what they were really doing was checking out the houses to figure out who to hit up for big donations. So the family in the $3 million house, they got asked for 5 times more money than their friend who lived in an apartment. It's a perfect, if a little creepy, example of why controlling how people see you is so important.
And mastering your attitude, this is all about emotional intelligence. When people ask how you became successful, just say you got lucky. It's a great way to disarm envy because, hey, everyone knows luck plays a part. Instead of bragging, praise what other people are doing and be open about your own failures. That's how you build a real connection. And remember, volunteering your time often earns way more respect than just writing a check. All right, let's bring this all down to earth. How do these principles actually apply to 2 of the biggest financial decisions we all make, the cars we drive and how we value our time? I love this image. It's such a great visual metaphor, isn't it? The path to true wealth isn't about having flashy, expensive accessories. It's about leaving a humble footprint and making smart, understated choices. And there's no more visible, in-your-face choice than the car sitting in your driveway. This is probably the #1 way people blow their stealth wealth cover without even realizing it. So, to fight this temptation, there's a simple, incredibly powerful guideline, the 1/10 rule. It's a really stark number, and honestly, it'll probably make you rethink your next car purchase completely. So here's the deal. The rule says you should spend no more than 1/10 of your gross annual income on a car. Take a look at this chart. If you stick to the rule, you're a financial hero. But as that percentage starts to creep up, you're basically just signing up to work for a very, very long time. And when you think about the fact that the median price for a new car is over $40,000, this rule really shows how out of sync our spending has become with what we actually earn. Now, let's switch gears from cars to time. We've all been taught that doing everything ourselves, the whole DIY thing, is the responsible, frugal choice. But let's push back on that scarcity mindset for a second and think about it a different way. So the key here is to do the math on the true cost of a task. Your time has value, a real dollar value. Let's use this example. If you earn $50 an hour and you spend an hour cooking a meal that costs $30 in groceries, that meal didn't cost you $30. It really costs you $130 when you factor in your time and everything else. Once you start calculating that opportunity cost, outsourcing things like cooking or cleaning might not be an indulgence at all. It could be a really smart financial move to buy back your most valuable asset. And that brings us right back to the ultimate goal. This whole thing isn't just about optimizing your finances. It's about optimizing your life. The stress from a high-pressure finance job can lead to some serious chronic pain that only goes away when you finally quit. This quote is so powerful because it reframes pain, physical or mental, not as something you just push through, but as a critical signal from your body that your life needs to change course. Because at the end of the day, all the money in the world means absolutely nothing if you don't have the health to enjoy it. Once you're on a solid financial path, your #1 goal should be to live as long and as healthily as you possibly can. And this is the final big reframe. Forget about being a millionaire or a billionaire in terms of money. The real goal, the ultimate prize, is to become a time billionaire. Someone who has an absolute abundance of their most precious, non-renewable resource, their time. So, I'll leave you with this question to chew on. Most of us spend so much time learning the mechanics of building wealth, but are you ready to focus on what that wealth is actually for, which is building a life of true freedom? So what if building wealth wasn't just about the money? What if it was really a strategy to conquer one of life's biggest enemies? Regret. Today, we're going to dive into a really powerful philosophy designed to do just that. This is the path of the financial samurai. Now, to really understand this path, we're not going to start with some big success story. Nope. We're starting with a warning, a powerful cautionary tale from a man named Conrad. And his story, well, It sets the stage for everything that follows. So meet Conrad. He was this super cheerful guy in his mid-50s who worked in the mailroom. Always had a smile, always had a story. One day, the author of our source material asked him a simple but, wow, a really profound question. What would you do differently if you were my age? And those were the words that changed everything. You see, Conrad felt totally trapped, trying to make it on a $40,000 salary in San Francisco, of all places. So this wasn't just, some generic advice. It was a warning that came from a lifetime of regret over risks he just never took. And then, just like that, he was gone, let go in a round of layoffs. And the story just ends right there, because that's the reality of it. Corporate loyalty, it's kind of an illusion. Nobody is going to tap you on the shoulder and say, hey, it's time to take that leap. You got to jump all on your own. So the big question is, how do you make sure you don't end up like Conrad, haunted by what-ifs? Well, you follow a different path, a disciplined path, inspired by the Warrior's Code. This is the path of the financial samurai. All right, so what in the world is a financial samurai? Well, think of it like this. It's someone who uses strategy, discipline, and courage to build a life where you're not constantly afraid of money. The goal isn't just to get rich, it's to have the freedom to make choices based on your purpose, not just because you have to. Look, the end game here isn't just about piling up a mountain of cash for the sake of it. No way. It's about building a financial fortress so strong that you can actually take those calculated risks. Start that business you've been dreaming of or finally switch careers without that fear of financial ruin holding you back. Okay, before we get into the actions, we got to talk about the mindset, because you can't act like a warrior until you think like one. This whole journey, it really starts with an internal shift, a change in how you fundamentally think about money and opportunity. This right here, this is the fundamental switch you have to flip in your brain. The scarcity mindset, that's the little voice that says, hey, there's only so much you can possibly save. But the abundance mindset, that's the one that says, hold on, there's an endless amount of money I can make. It's not just positive thinking. It's a strategic move from playing defense to playing offense with your money. So here are the core tenets, the rules of the road for this Warrior's Code. First up, never fail just because you didn't try hard enough. Second, and this is a big one, depend on yourself. Third, give without keeping score. And finally, and this is so important, think in probabilities, not in black and white absolutes. This is what opens your mind to new ventures. All right, now that we've got the mindset down, it's time to get into the missions. These are the clear, actionable, and pretty ambitious goals that are going to pave your path to freedom. Okay, mission number 1. Brace yourself, because it's aggressive. The goal is to save and invest 50%, 50 or more, of your after-tax income. Yep, you heard me right. Half. Now, the whole idea behind that crazy 50% target is to really push your limits. Saving should feel a bit like a tough workout, It should be challenging. If it feels too easy, you're probably not pushing hard enough. This is how you literally fast-track your journey to financial independence. And that brings us to mission number 2, your net worth target. The big goal here is to build a net worth that's 20 times your average annual gross income. Once you hit this level, you're not just financially independent anymore. You are truly, truly free. Now, here's a fascinating, kind of wild strategy. Instead of just handing in your notice and quitting your job, you negotiate a severance package. Think about it. If you quit, you walk away with 0. But if you can engineer a layoff, suddenly you've got a financial cushion, unemployment, healthcare, a severance, to go and fund your next big adventure. Okay, so as you start to succeed, you're going to have to fight that urge to show it all off. That's where stealth wealth comes in. It's all about staying humble, because flaunting your success, it can just attract negativity, and frankly, it can make other people feel bad. The real warrior, they move quietly. They let their freedom do the talking. So, all of this, it's all building up to the final, most important objective. Because, let's be real, after all the saving and the investing and the strategizing, the numbers are just a tool. The real prize? That's a life lived with purpose. And that brings us right back to where we started, back to Conrad's warning. You see, every single one of these principles, all these missions, they're all designed to give you the guts to answer this one question for yourself. What risk are you going to take to avoid regret? What leap of faith will you take?
And that really is the ultimate takeaway here. Being a financial samurai, it's not some finish line you cross. It's not a level you finally beat. It is a way of life, a continuous journey of growth, of discipline, and of purpose.